everybody, it's Tortoise Investing coming at you today with the best stocks to buy now. We're going to be taking a look at three of them: Hershey Company, Paychex, and Microchip Technologies. Now, before jumping into that, if you're new, make sure to hit that subscribe button, drop a like down below. That really helps out a bunch with the YouTube algorithm. It is a tricky one. I greatly appreciate it. Now, we'll go ahead and take a look at the portfolio before we dive into that. We are currently up 26.48% year to date. The market, S&P 500, is up 19%, so beating it by a little over 6%. Hopefully we can keep that gap into finishing the year off. My portfolio has done a lot better than I thought it would, and it is a satellite and core setup, SCHD being my core, and then I've got my individual satellite holdings built around it. We'll take a look here at the holdings tab. My top performer, Ulta Beauty, coming in at 21.5% up. Canadian National Railway 11.7% up, and Texas Roadhouse 9% up. My bottom three: Extra Space Storage 2.28% up, SCHD 0.3% down, and Hershey down 12%. I'm still going to be DCAing into that. As long as it is down, I will just accumulate as much Hershey share as it will allow me in the 180s. Now, let's go ahead and take a look at Hershey. Hershey Company, just free cash flow yield of 4.14%. It is down off of its high of over $270 back in May. Got a dividend yield 2.5%, payout ratio 46%. I really like this company. Revenue's been increasing at a rate of 6.75% over the last 5 years. Free cash flow has been increasing at a rate of 8.27% over the last 10 years. So right there at double-digit growth, and if you look over the last 5 years, it is increasing over 12.7% free cash flow. EPS 10.6%. Growing EPS is a growing company. You love to see that. Debt, they have $3 billion in debt. Their EBITDA is over $2 billion. My rule of thumb is I don't like companies that have 3 times more debt than their EBITDA. That shows that the balance sheet's a little off. And this one, fantastic balance sheet. Hershey has always been able to manage their money and debt ratio very well. Dividend's been increased at a rate of 9.41% over the last 10 years. Here recently, they have been giving bigger and bigger hikes, which is going to make that compounding even better and quicker. Love to see it. Shares outstanding, there's not too much to look at here. They do very little share buybacks here and there. And return on capital employed, 19% in 2020, 20.3% in 2022, and 21.8% in 2021, and 2022 is 21.8%. So a growing ROCE, usually market average is around 9 to 10%. So that is very good. Next up, we got Paychex. Their competitor is really like ADP. I really like this company. It is at a just free cash flow yield of 4%, so not too bad. It is up 6% this year, so it hasn't really taken off all that much, but there's a lot to like about it. Dividend yield 2.87%, payout ratio is at 76%. Revenue 7.97% growth over the last 10 years. Free cash flow 10.44% over the last 10 years. Love it, love double-digit cash flow growth. EPS 10.6%, very similar to Hershey. They have more cash than debt on hand, and in an environment where interest rates are high, hopefully they start being ticked back a couple notches here and there starting next year. Next year's right there. We are rounding out the year. But hopefully, if in the next 6 months we can get 1 or 2 rate decreases and make the interest rates not as bad. But even then, if that, they have more cash and debt on hand, they could just pay that off if they wanted to. The dividend's been increased at a rate of 9.78% over the last 10 years. Shares outstanding, again, not really too much to talk about there, but their ROCE, return on capital employed, 42% last year, and this year 42.88%. That is amazing. That is knocking it out of the park. And another thing that I love about this company, their CapEx isn't really increasing all that much. So they're not having to spend a bunch of money to make a bunch of money. It's pretty much been right even for over a decade now. It's not really went up or down all that much. And lastly, we got Microchip Technology Incorporated. Adjusted free cash flow yield is 6.57%. This one's been on a little bit of a run this year at 21%, but might be something you want to look into. Dividend yield 1.88%. Got a payout ratio of 32%. This one's interesting. Caught my eye for a reason I will show you in just a moment. Revenue's been increasing already 18% over the last 10 years. Free cash flow 23% over the last 10 years. Very nice. EPS with 29%. Semiconductor stocks are just taking off this year. It's nuts. Debt, they have 4.88 billion in debt. Their EBITDA is 3.78 billion. So again, my rule of thumb, 3 times. There's no issue there whatsoever. And before we get into the thing that's really interesting to me, they have started buying back shares, which is great. Love to see that. It's a little bit here and there, but the fact that they have started it makes me happy. That return on capital employed is at 23.5% for 2023, and it's just going to be growing as they're buying back more and more shares. Now, the thing that's really interesting of this company is the dividend. We're going to take a look here over the last 3 years. Quarter over quarter, they have increased their dividend. Yes, you are getting 4 increases a year to your dividend if you've held this since, was it 2021's when they started doing this? So yeah, they are, to me, that just says that they are so flooded with cash that they don't know what else to do with it. They're now doing share buybacks and are giving you quarterly raises on your dividend. Now, if you haven't heard of this company before, I did pull up this little news article here just to kind of give you some quick information about it from the Motley Fool. Headed into a downturn, but it's been through periods like this before. Company still expects to be highly profitable and could be a great long-term value. Now, all-weather chip stock, apparently from ups and downs and all arounds, they're able to just keep on trucking through. And there is great growth in income. So this right here shows their free cash flow is increasing, the dividend that they pay is increasing, and their long-term debt is decreasing. So this looks very promising. Again, might be something you want to look into. None of this financial advice. But yeah, 3 best stocks to buy now. Hope you enjoyed that. Stay tuned for more. And until next time. See you.